Higher energy prices pushed Canadian inflation up to 2.8% in April, but our guest says that that's actually well below the level that was expected. And joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. And Robert, thanks for joining us.
My pleasure, Anthony. It's always great to be back.
All right, so we saw the inflation report. What's your take on the latest news?
Yeah, no, my take is that, this was obviously quite a bit softer than expected. Both we and the market were looking for inflation to rise from 2.4 to 3.1%. And the underlying details were added to that dovish tone of the report as well. So not only was inflation softer, but it also wasn't terribly broad-based. You did see that larger increase in energy prices, but not many signs that higher energy prices are starting to spill into other goods and services. The share of components in that basket that are seeing abnormally large price gains, that actually ticked a bit lower. And the two core inflation measures that the Bank of Canada tends to look most closely at were also a little bit softer than expected. Those fell to 2 and 2.1%. Just over the last 3 months, they're still only at 1.8% on an annual basis, which does speak to the fact that we are not seeing material downstream effects from higher oil prices. So the Bank of Canada's said that they are comfortable looking through headline inflation. So far, we don't see anything to change that.
Okay, so we had that high headline number, but you're not seeing any downstream effects in inflation. So looking ahead, what are your expectations for inflation going forward?
So going forward, we do expect to see a little more pass-through from higher energy prices. So, you've already heard anecdotes about, some groceries might be adding more charges to their suppliers for higher transportation costs. You've also got significant cost pressures from fertilizers across the agriculture sector. And you've even seen some airlines either raising their base fares or adding new surcharges for oil prices, raising baggage fees. We have seen some anecdotal evidence that some businesses are taking measures to account for higher costs of oil and gas, but that's not broad enough to really impact the total numbers yet. Going forward, we do expect to see a little more of that, but don't expect material impacts outside of food prices, airfares, the ones that have a higher tie to energy and agriculture. Likewise, while core inflation is still sitting at 2% now, we do expect for it to trend a little bit higher into the second half of this year. So we think that core inflation will get back to about 2.5% by the fourth quarter. Not near levels that we saw back in 2022, the last time oil prices were near $100, but it certainly would take a lot to go right to see core inflation stay at these levels. So another thing we've seen is that some Canadian firms in recent business surveys have said that they are facing more significant cost pressures, might have to raise their prices going forward. So this is something we'll keep watching very closely. But right now, it looks like that has been really contained for the last 2 months.
Okay, so given that inflation outlook, what does this all mean for the Bank of Canada and, more importantly, interest rates going forward?
Well, like I said, the bank has said that it can continue to look through the impact of higher energy prices on headline inflation, but it doesn't want inflation to become persistent or broad-based. And that ties us back to that 2021-22 experience where energy prices went from $60 to $100 over a short period of time, but that occurred in the context of pre-existing transportation bottlenecks and supply shocks coming out of the pandemic. So, this really kind of illustrates the different backdrop between 2026 and 2022. For that reason, we think that the Bank of Canada can remain patient. The market is still priced for more aggressive BOC hikes by the end of this year. We were priced for 2 more hikes heading into this inflation report by December. We think that rate hikes are going to be a 2027 story. So as the market digests the impact of this report, that can that can provide a little bit of relief. We've seen the market push rate hikes a little bit further out on the heels of the inflation data this morning, but we think that there is still too much priced into the front end for rate hikes.
Okay, so we've got the latest inflation numbers. We had that weaker job number as well a little while ago. What's your overall impression of the Canadian economy right now?
Overall impression of the Canadian economy is that, we are seeing growth start to get a little more traction. We've seen significant fiscal spending over the last 6 months and continuing through this year. And even though, trade uncertainty is still very elevated, it's not nearly as extreme as it was kind of in that March, April phase of last year. So going forward, I expect to see a little bit more of a stabilization. We are going to see the impact of higher oil prices push headline inflation higher for the coming months. But we're probably not that far off the peak as long as oil prices stay near that $100 a barrel or so, as we've seen over the last few weeks. So core inflation is going to catch up a little bit, but don't expect it to get anywhere near the top of the BOC's target range. And that means that the BOC can just stay patient here, wait for that stronger growth to absorb some of the spare capacity in the economy. So I think stabilization is the key word here, and much of this is going to depend on the evolution of the geopolitical outlook. But so far, it seems that we are starting 2026 on the right foot.